Okay, so in this episode, we are going to be talking about positive gearing and positive cash flow. And they both are not the same thing. They are very, very different. Hi, my name is Amit. I'm your professional buyer's agent, and I help you build self-sustainable property portfolios, targeting short-term growth, high-yielding properties, without compromising on long-term growth on the basis of data and research. So straight into today's topic, positive cash flow and positive gearing. You might have heard these terms being used interchangeably, or you might have understood them incorrectly, assuming that they both are one and the same thing. To put it into simple terms, I will just say that positive gearing is the financial situation and financial outcome of an investment property before your personal taxes have been taken into consideration. And positive cash flow is the situation you are in after your taxation has taken effect with input from that investment property. So to understand it clearly, for example, let's say you have an investment which makes $20,000 a year in rental income. And after making payments of your interest rates, management fees, occasional repairs or maintenance, any expense that has been part of holding onto that property has been taken off from the income that was coming from the rental. And let's say that was $15,000 for the year. So incoming 20,000, outgoing 15,000, remainder is 5,000. That property is positively geared by $5,000 a year. So in simple terms, that is your positive gearing or positively geared property. Similarly, if your expense in this scenario would have been $25,000, incoming 20,000, outgoing 25,000, minus 5,000 is the balance. So that property would have been negatively geared by $5,000 a year and making a loss when you're looking just at the property without taking into consideration other financial aspects or your personal taxation. So let's now move on to the positive cash flow. Positive cash flow, as I mentioned earlier, is your situation after your taxation, having the input from a property which you hold as an investment. So another interesting factor here is that a negatively geared property can actually put you in a positive cash flow situation as well. I'm not saying that is the best position to be in on one should actually do that. I'm not a big fan of negatively geared properties. I do not really like them, though they can put you in a positive cash flow situation after your taxation. But at the same time, a positively geared property can actually result in paying more taxes, but at the same time, it also increases the take-home cash, the income that you get in your pocket. Your disposable income can actually increase through a positive cash flow property. So rather than saving on taxes, I would pay a little bit extra taxes and also have more cash in my pocket. So how does a negatively geared property becomes a positive cash flow? For example, your property is generating the income of $20,000 a year. Your expenses are $25,000 a year. Your loss on that property is $5,000 for that year. And your income, regardless of whatever your income was, the taxes that you have paid is, for example, just for this scenario, $20,000. And that is what you should have been paying from your salaried income or business income. So there is no taxation refund due to you. But as soon as the loss of $5,000 from negatively geared property comes into your taxation, you actually will end up saving taxes on that $5,000 component. If you have been paying 35% tax, you'll be saving 35% of the $5,000 loss, which will be roughly 1800 dollars in your pocket, and you will in that scenario get that 1800 dollars refund from the taxation. So all of a sudden you have that extra money in your pocket which has come back from your taxation. So that is tax saving. So that is pretty much it on that topic. There's not much more to explain. Positive cash flow is before tax, the position of the financial position of property, and the positive cash flow is after tax financial position of an individual after taking into consideration the input from property's performance. So let's now talk about what actually works best in terms of putting more money in someone's pocket. I personally prefer positively geared properties. It does mean that at the end of the day, I might pay more taxes, but at the same time, it also means it will put more money in my pocket. To give you an example, let's take the same example of a property which is earning $20,000 in rent a year, and the expenses are $15,000. At the end, you have $5,000 in profits left over. Now, profits in property investment means your income. If I'm on an income of $200,000 a year, I'm paying, let's say, top tax bracket of 40%. Then that $5,000 will add on to my income. It will become $205,000. I will pay additional 40% on the $5,000 component. What that means is 40%, I'll end up paying $2,000 from the $5,000 profit that I've made on the property. But it also means that the leftover $3,000 is for me to use. It is my disposable income. So my income then becomes $203,000. And that is exactly the reason why I prefer positively geared properties, because at the end of the day, a negatively geared property can still give you taxation benefits, but I wouldn't really mind paying more taxes and having more cash in my pocket to use the way I want to use. So yeah, these are the basic differences. I'm not recommending you go one way or the other. I cannot advise you on taxation. I cannot give you financial advice. So again, at the end of the day, it's someone's personal choice in line with their personal goals and long-term outcomes that they want to achieve from property investment, on what works for them and what will actually help them get where they want to get. So you would have experienced that a lot of people advise on buying newer properties or new construction so that you can get depreciation benefits and ultimately save on taxes. Yes, those properties generally wouldn't have very high yields and they will be negatively geared, but still, despite being in a negatively geared position, you will at the end of the day have some positive cash flow just by um, using the depreciation benefits. And also a lot of people do not know that the depreciation which you have initially claimed on any property is actually then adjusted and added on top of the capital gains when eventually you sell the property many years later. So whatever you are actually benefiting now from claiming on depreciation and then claiming some tax benefits out of it, those depreciation amounts will be added on to your capital gains, and then you will be taxed on that eventually. So if you look at it with this piece of information, you are eventually paying that back. Okay, so that is it for today. I'll wrap it up now. If you have been enjoying what you have been watching, please do subscribe. As I've said earlier as well, it's a huge encouragement. It motivates me to keep doing this. If you have any specific questions, feel free to ask in the comment section. Or if you have a topic that you want me to cover in relation to property buying and investing, let me know. I'll do my best to do something on that as well. That is it for today. Thank you.